Good morning, ladies and gentlemen. My name is Lukman, Senior Research Analyst at FXTM, and I'm joined with Han Tan from Malaysia.
I'm Hantan, market analyst at FXTM. Sorry, there was a bit of a gap there. I didn't know if you were wanting me to jump in and introduce myself, but take it away, Lukman.
So before we proceed, I'd just like to confirm if everybody can hear us clearly and see our screens. I'd just like to see a show of hands if everybody can hear us clearly and see our screen before we proceed. Okay,
Well,
perfect.
obviously not your physical hands, ladies and gentlemen, but your
So perfect. So I'd like to welcome everyone today, to our monthly market outlooks that we've been doing for the past few months. We've all made it to the second half of 2020. I think we all should give ourselves a pat on the back. The first half of 2020 has been absolutely amazing. There's been so many themes ranging from the coronavirus developments that we've been seeing, moving markets, the return of US-China trade uncertainty, geopolitical tensions, optimism over the global economy recovering faster than quicker, disconnect between markets. The list goes on and on. All I can say is I think the first half of 2020 will go down in history as one of the most volatile periods in financial markets since the 2008 crisis that we've seen over 10 years ago. And this leads us to the question, is volatility here to stay? So our main objective today is just to look at a couple of currencies, a couple of themes, discuss possible trade setups for this coming months, and to just explain, what's on our minds and to take questions and answers. As I said, this is a fun session, so let's have fun and let's break down the markets. So before we move to the fun stuff, I'd just like to share a quick disclaimer with everyone. So I'd like you all to know that the content presented, in this presentation comprises of personal opinions and should not be construed as trading or investment advice. Trading forex and leverage financial instruments involves significant risks and can result in the loss of your invested capital. You should not invest more than you can afford to lose, and you should ensure that you fully understand the risks involved. Trading is risky at all times. Thank you. Let's get this party moving. So we're going to start with the British pound. The reason is, I live in the UK. I get paid in pounds. I spend my money in pounds, and I'm not really too happy with the pound so far. We're gonna break it down as quick as possible. So the title is Pound Begins Countdown to Hard Brexit. So for those who attended the last webinar last month, I think the main theme that we're discussing that will move the pound is these whole Brexit negotiations. But surprise, surprise, it looks like we're back to square one. The Brexit is back at a deadlock. The United Kingdom and the European Union are still where they were before the month started, and the fact that the deadline has passed for the UK to extend that Brexit extension, it does raise questions whether the UK is en route to leaving the European Union by the end of 2020 with no deal in place. And this is one of the key themes that have hit the British pound. If you look at the picture to the right, the pound's performance against G10 currencies in Q2 has been quite poor. It's weakened against almost every single G10 currency, excluding the Japanese yen. The other factors that I see hitting the British pound has been economic data. It's been mixed. So in April, we had that really abysmal GDP growth, which showed that economic growth in the UK tumbled more than 20%. But on the other hand of the equation, we've seen that PMIs have been rebounding and retail sales have actually, rebounded sharply. And considering how sales is an engine of growth for the UK economy, this is putting some light at the end of the tunnel. To add to that, the Bank of England is also expecting a V-shaped recovery. But let's see how this plays out. Moving forward, though, I think the threat of a new COVID cases in the United Kingdom, threatening the fragile recovery and resulting in another round of lockdowns is a key theme that may hit the British pound in the coming months. And this is something that could result in further weakness against the pound and other G10 currencies. Now, the next chart shows, the next slide shows the chart, and this is the potential performance we're seeing for the British pound in July. So they say a picture can say 1,000 words, and we can see many things playing out here. The pound US dollar remains in a wide 300 pip range on a daily charts with support around 12250 and resistance at 12550. We could also see some support around the 50 and 100 simple moving average. So this is quite significant because if this support holds, this may open our path back towards 1.2550, and a breakout above this point may inspire an incline towards the next important resistance level based around 1275. Alternatively, though, we know that the British pound is really being hit and battered by fundamentals, and the fundamentals we've been discussing earlier: Brexit uncertainty, disappointing data, and the threat of new COVID cases. If all these things really haunt attraction towards the British pound, the British pound has the potential to sink back towards the 1.225 level, and a breakdown below this point could open our path towards 12070. So we have a really interesting month ahead for the British pound, but naturally it's all about the fundamentals.
Yeah, at least for us, isn't it, Lukman? Thank you so much for that. And it's amazing how the outlook on the pound can very easily adopt this positive glow to it. Lukman earlier mentioned the retail sales data. And now, for those of you who are joining us for the first time, keep in mind, unlike the webinars that the folks at FXTM may offer, Lukman and I, we look at the fundamentals. So we look at GDP, PMIs, retail sales, that kind of stuff, instead of head and shoulders and all the other stuff. Now, if you are not familiar with these terms, certainly encourage you to check out the FXTM website. We do spend a lot of time and resources on educating and interacting with our with the good folks like you. So we have an education section there that kind of gives you a breakdown of all these terms that we are using today. All right. Now let's move on to the Aussie dollar. I'm going to spend a couple of minutes on this. I know for those of you who were with us at our last webinar, this is a monthly outlook webinar. We had a couple of questions from you guys about the Aussie. Seems like it was quite popular, so we want to spend some time in this webinar to go over something that potentially you guys are interested in. All right, so here's a look at what happened in the second quarter leading up to today. This is the performance of G10 currencies against the US dollar, and as you can see right there in your screens, folks, all the way at the top, the Aussie dollar was the champion among G10 currencies for the second quarter, and it's still holding that position in these first few trading days of July as well. Why is that? Because of these key drivers that you see on your screen. Your risk on sentiment. China was the first major economy to reopen post-pandemic, and there was this rally in commodity prices as well. Keep in mind, if you look at that chart, right, look at the top 5 of those currencies, the top 5 best performers against the dollar since Q2, and a lot of them are linked to commodities rally, right? Aussie dollar, Norwegian kroner, Canadian dollar as well, right? So there is that trend there. And then also looking at the RBA, that's the Reserve Bank of Australia, that's the central bank there. They sound less dovish than some peers in the G10 space. A few months ago, not too long ago, they were talking about maybe Australia could look at negative interest rates, but there's since pullback from that kind of talk. And tomorrow, there's a decision by the RBA, but markets expect them to keep it at record lows, but still in a positive territory. And also, being a smaller country with only about 30 plus million population, they've got an easier handle on the domestic outbreak. But if you guys are following the news like Lukman and I have, there are pockets now of a resurgence some of these cases there. So if I mean that scenario or that situation is still quite uncertain. If they have to reimpose more lockdowns, I mean they are doing some of that already in New South Wales and Victoria, but it's not quite the national scale that we saw a couple of months ago. So we'll definitely keep an eye on that for this month. Okay. So looking at the charts, so I still expect it to remain range bound. 0.7, that's for the Aussie. I think that's pretty much as good as it gets. And here's why. And here's the key point for the Aussie here. A lot of the good news or the optimism around Australia, it's been front loaded. It's been big. And that's why you saw this sharp ascent of the Aussie dollar against the US dollar from March, as you can see on the chart right there. Okay. And you saw the blue line crossing above the green line and the red line. For those of you who are not familiar, this confirms when the blue line crossing above the green and red lines, it confirms this up. So the question is, for this month and going through Q3, are we going to see a continuation of that major spike? Well, my take is that I don't think so. I think it's reached its peak for now. So still range bound in the upper sixes and hitting 7 there. Stronger support seen at 6.7, which is where the red line is converging. That's the 200-day simple moving average. So if we want, or if some of you want or wish the Aussie dollar to break higher above 0.7, these are the conditions that we need to see. So first, you need to see a weaker US dollar, okay, which has been stubborn these past couple of months. Number two, you got to see a huge rally in commodity prices like we saw since April. Okay, so oil prices, for example, still around 40. It's been there for the last month or so. Can it really climb higher? I don't think so, unless something really changes in the global pandemic and the supply and demand picture there. Of course, with the Aussie dollar being a liquid proxy, liquid meaning that it's very popularly traded, as I'm sure some of you are well aware, and it's a proxy to what's happening in China and others. Markets tend to trade the Aussie dollar based on their outlook or their sentiment over the Chinese economy, because Australia is the most dependent major economy, the most China-dependent major economy in the world, at least among its G10 peers. Okay, so that's the outlook on the Aussie dollar. I think zero point 0.7, that's about as good as it gets, at least for this month. All right, over to you, Lukman.
Thank you, Han. I think for once we both share the same thoughts on the Australian US dollar. We're on the same team. Let's see. So we're gonna hit the euro right now, and for those who have been watching the euro dollar, especially last month, it's placed many on an emotional roller coaster ride. Especially the euro dollar, which we're gonna cover shortly. And my question for this month, is will the euro become the sick man of the G10 space? So there's many factors pulling and tugging at the euro's valuation. I think one of the key ones was the resurgence in coronavirus cases in Germany and other parts of Europe. Now, not only the world economy, but Europe is still struggling to nurse those deep wounds inflicted from the lockdowns. And another round of cases that results in another lockdowns could have crippling consequences on the European economy, despite the European Central Bank efforts to create some sort of stability. But on the other side of the equation, we saw the PMIs rebounding. For those who attended our webinar last month, PMIs were at record lows, but it looks like PMIs are rebounding, are roaring back to life, which is fueling some sort of optimism that the European economy could be heading for a V-shaped economic recovery. And when I mean a V-shaped economic recovery, I mean a case where there's a sharp decline in growth, for a short period, followed by a sharp rebound. But I think it's too early to come to that conclusion. For us to know that, we need to see how economic data plays out over the next coming weeks. One key thing is, though, the EU leaders are still divided on this massive pandemic stimulus plan. And, we know how fiscal policy has been, implemented to fight the COVID menace. And I think until the leaders are able to come to a conclusion on this, I think the outlook for the euro remains muted. And finally, broader risk sentiment. So last quarter in Q2, there was a massive disconnect. Even though coronavirus cases were rising, we saw stock markets still pushing higher. And I think today's a perfect example. COVID cases are still rising across the world, but stock markets are still pushing higher regardless. But I think if risk aversion re-enters the scene, this may hit the euro. So overall, the euro to become the sixth man of the G10 space, likely, but let's see how things play out. And they say a picture paints a thousand words. This is why we're going to move to the charts. So the potential performance for July. I still believe that the euro dollar remains under pressure on a daily time frame, despite the sharp breakout we saw this morning above the 1.1270 level. And the major reason is dollar weakness. We've seen the dollar weaken across the globe, and this is providing some support to euro dollar. If though we do see a strong daily close above the 1.127 level, the medium to longer term, trajectory for the euro dollar could be as far as 1.1400. Alternatively, though, I can see that there's some resistance around that 20 super moving average, and a move back below 1.1270 could encourage a decline towards that 1.1200 psychological level. When I mean a psychological level, it's a level where prices tend to rebound or react aggressively towards. If we break below that 1.1200 psychological level, the other support levels have been marked at 1.150 and 1.110. But as I said, the outlook for the euro this month will be really heavily influenced by whether EU leaders are able to sign off that fiscal package and whether economic data continues to recover, or what we've seen over the past few weeks has just been a short blip on the map. Over to you, Han.
All right, great stuff. Great stuff, Lukman. Hey, folks, I just want to do a bit of housekeeping here. So we got a and good morning to you wherever you are. But we got a comment that the volume is perhaps slow. So that's why if you guys see me fiddling with my mic, I'm trying to respond to that comment there. So folks, if you can just do another quick survey by show of digital hands, and you can find that in the bar on the right side. Please raise your hands if you can hear myself and Lukman all right. But if I don't see enough hands, then I probably have to do this the whole time then. All right, so just a quick audio quality check. Okay, thank you, folks. So I'm seeing some hands raised. Okay, so yeah, okay, I think we can continue. So for the person who sent in that comment, well, thank you for notifying us firstly, but perhaps it's your settings as well. Also, ladies and gentlemen, just want to take this opportunity to mention that you can feel free to post your questions even right now. We will have a dedicated Q&A session at the end of this after our presentation, and then we'll address them there. But please feel free to post them in now, as opposed to waiting for this mad rush later, because I've been reminded that we got conscientious of the time that you good folks have taken out of your day to spend with us, and we appreciate it. But we want to make sure we try to keep to that half-hour um, uh, time allotment as much as possible. Okay. All right. So moving quickly along. So this is the final section. And then look a couple of things on MT4, and then we'll get to the Q&A. So feel free to pose your questions now. So we're going to talk about gold. I know this is something that many of you are talking about. So we'll just go ahead and dive right into it. Okay, so obviously we are seeing this tremendously supportive environment for gold, right? For those of you who track gold very closely, we saw it just this past Thursday, right? We saw this another positive surprise in the US jobs data. You see gold just fall right below 1760, and just within a few hours comes right back up, right? So there's plenty of demand for gold, being 7 consecutive quarters of gains for gold prices. Okay, you can see in this chart right here. So it's nearing those levels that we haven't seen since 2011, 2012. So that's about a 7-8 year high there. So obviously there are concerns over the global recession that we are facing right now. And another tailwind, that means that's something that's supporting it from below, is the US interest rates, which are at near zero right now. So that's supportive. However, on the other side of the coin, you've got this stubborn dollar that's in the way. And to be honest, I personally think that dollar will remain stubborn at least for the coming weeks and months. Even though the world desperately needs a weaker dollar, the world needs a weaker dollar to help it recover, right? So emerging markets can pay back the debt easier, exports become more affordable, but that's not happening, right? We have this stubborn dollar. So that is a common theme throughout many of these asset classes that we showed you earlier. That's why you see the pound being range bound, you see the Aussie dollar range bound, euro range bound against the dollar, because we have a stable softer but pretty stable dollar there. Okay, so that's capping the gain for gold. I'll be honest, and Lukman, you can laugh at me for this. I don't care. I'll give you this chance because I've been calling for 1800 gold since the first quarter until now. 4 months later, we are still yet to hit that 1800 mark. Gold futures did hit 1800 just briefly. It's not spot gold, which is what we're looking at. So, it's because of that stubborn dollar. Of course, with these outs of risk on mode that have just been trying to chip away at the gains that it has made. But still, overall, it's on this uphill climb, slowly but surely. So what's actual performance for July? Again, these are personal opinions and analysis. Take it for what it's worth. So I still think that it could yet breach 1800. You look at the MACD; those are the bars at the bottom of the charts. They're still in positive territory. The 50-day moving average is still on an upward. So I expect it to still climb. But to the downside, if let's say maybe not a vaccine, but for some reasons another event out there in the world that we don't expect that just really encourages risk on sentiment, could see the support level for gold at 1754, and then after that at 1670, as has been the case on the daily charts since about April or so. All right. Now, I think Lukman has some MT4 charts ready. So now, if these potential trading opportunities are something that you are interested in, or then the Lukman, I think, will demonstrate how you can possibly take advantage of those and actually go through the mechanics of
Yes.
placing those orders on MT4, right? So over to you, Lukman.
Perfect. Thank you very much, and thanks for that. I just want to confirm if everybody can see my MT4 charts clearly. Now we've gone through the
Yes, we can.
theory, we can go through the practical. So, this is everything we've been discussing today. So with the euro dollar, so initially we said euro dollar to remain sick man of Europe. This is fundamentally, but technically we're seeing a couple of things playing out here, and this is why today is very, very important. If the euro dollar is able to really secure a solid daily close above the 1.127 resistance level and push slightly higher, and the dollar continues to weaken, the next key point of interest for the euro dollar could be around 1.1140. So for those who would like to, remember, this is all hypothetical. This is not investment advice. We're just going through this for educational purposes. So I'll be looking at least a solid breakout above the, 1.312 regions, with a stop just below today's low around 1.124, and of course take profit around 1.140. So, for such a setup, you may be looking for something called a buy stop opportunity. So you go to trading, new order, not instant execution, pending order, a buy stop. So just for those, a buy stop order is an order where you expect prices to push higher. So it's normally higher than the current prices. So as we said, the buy stop order will be around 1.1320, take profit at 1.140, and as we said, stop loss around 1.1230. As I said, we're just giving an example. This is just an example of a possible setup. And going back to what Han was saying about the Australian US dollar being 0.70, 0.705 being, as good as it comes. That suggests that in the longer term, Han is, suggesting, Han, we're looking at the Australian US dollar to actually find a ceiling around the 0.705 level. So there's an order called a sell limit order. So a sell limit order is simply an order where you feel or where you believe there's going to be a strong resistance level or point. And after prices hit that point, prices tend to trade lower. So to move along with this sell limit order, it's a pending order, sell limit, price at 0.7050. Take profit, stop loss higher than the sell limit order at 0.710, and as we said, we can see it's in a range with resistance at 0.750 and support at 0.680. So that's where the take profit would be. And the order should be placed. So, over to you, Han, while I fix this, while I sort this out quickly. Yeah. Oh, okay,
Yeah.
no, I see where I went wrong. Look, it's fine. I see where I went wrong. So it's always attention to detail, so it should go through right here. Okay, and there it is. So, as I said, guys, this is all hypothetical, and the types of orders that you can place based on, where you see markets are going to trade. Okay.
All right. Thank you for that, Lukman. So yeah, we've got a few questions ready. Thank you for that. And yeah, it looks like we still got about 5-10 minutes for those questions. So keep them coming in. The first one, I think, pertains to the euro here. And thanks for this, Fifi. All right. So Fifi's asking, okay, besides the weaker US dollar, what else could push the euro higher? I know I'm paraphrasing here, but it's a bit hard to read some of these. Yeah, so what would it take to help push the euro higher other than the weaker dollar? Now, I think Lukman has already covered some of these factors, but by all means, we would be more than willing to go over some of these with you again if they weren't clear. So obviously it comes down to the fundamentals, right? At least in our view as we look at it. So if you look at the Bank of France, their central bank just over the weekend said that, well, guess what? The hit to the French economy from the pandemic is not as bad as feared. So the recovery in France is actually better than expected. That's the word you use, better than expected. So, if we can see more of that same narrative, this better than expected recovery across Europe, I think that will push the euro higher, right, versus its G10 peers. To be clear, though, there are still some pockets of concern. So, for example, there's a certain part in Spain. I can't remember the name of that region, but they had to go into some more stricter lockdowns again. All right. I think just over the last few days. So that's going to be the norm moving forward, right? I don't think it'll be a case of countries going into nationwide lockdowns again. For the simple reason is I think they've learned their lesson and they just plain cannot afford it. They cannot afford to have the economy go into a full lockdown again. So they'll try and manage it, make it more sectorial or more geographically targeted. I know in the UK where Lukman is, Leicester, right? Lukman, just last week they had to kind of reimpose some lockdowns there again, right? So the idea is that which economy can handle their domestic pandemics or domestic outbreaks better, then I think that will either make the outlook on the currency more positive or more negative. Just like the Aussie I mentioned earlier as well. So a lot of that good news or optimism has been baked in, but now with New South Wales and maybe some parts of Victoria as well seeing a resurgence, I think that's going to dampen some of the upside for the Aussie. So that's one of the key factors that we have in mind for the fundamental outlooks for these currencies. Lukman, is there anything else you want to add or go over again on the euro before I jump to the next question?
Yeah, no, you pretty much covered it. You pretty much it's more fundamentals. If it's not a weaker dollar, it's just investor optimism that the COVID hasn't really the damage the COVID has done to the European economy is not as bad as initially expected, and economic data over the coming few weeks, printing harder than expected. These are and naturally, of course, EU leaders, as approving that massive fiscal budget. All those things will most likely push the euro higher regardless of where the dollar's trading.
All right. So I mean, just to note, guys, I am seeing your comments about the poor audio quality, but then keep in mind we're also getting comments that for others, I think like for Tala, the sound is loud and clear. So
Yeah.
I mean, keep in mind this is a webinar, it's a global thing. Lukman's in London, I'm in Malaysia, so it might be your local network thing, but we will still press on. And yeah, we'll see how this goes. So this next question here is from Farid and says, okay, well, after years of, um, hold on, after years of back and forth on Brexit, haven't investors priced in the
Mm.
possibility of a hard Brexit by the end of the year? Will the pound be able to hold its ground, or will it shed more weight? I think that's a great question here. Lukman, I'll let you take first dibs because it
Yeah.
hits home for you, buddy. It
It,
hits home.
it does hit home really, and I think everybody's really tired. It's been over almost 4 years. Getting to 4 years of the back and forth, and you just need to look at the pound's valuation. Like every single time, I don't think the possibility of a hard Brexit has been fully priced in, simply because nobody can really gauge or really evaluate the ramifications it will have on the UK economy or European economy. It's a complete grey area, uncharted territory, something that's never happened before. So what we're seeing most likely is just speculation. So speculation. I think once it becomes reality, this has the potential to actually drag the British pound lower, lower than we saw in the first half of 2020. But just going back to what you were saying as well, there's so many things, what I've learned, especially with Brexit, is to always expect the unexpected. Even though during this webinar we said that the pound counts down to hard Brexit, who knows? Probably because of the COVID-19 and the uncertainty it's created, this could actually encourage the EU and United Kingdom to actually delay the Brexit negotiations well beyond 2020. So anything's on the card, but I don't think it's been fully priced in the British pound, not yet.
Mm. All right. With the little time that we have left, we're going to segue into, I mean, thanks for your questions, guys. We're going to go into geopolitics here. We've got a question from Anmol. I hope I'm pronouncing your name correctly. And okay, I'll take this one because this is closer to my home here in Malaysia. So Anmol is asking about the effect of the US naval exercise in the South China Sea. Okay, the short answer to that is not much. Okay, because even if you look at the last couple of years under the Trump administration, and there's a lot of saber rattling, right, between the US and China, right? There's a lot of threats, tit for tat going back and forth. And even amidst all that, okay, I mean, forget about the coronavirus for a second. Even if you go back over the last couple of years, with all these threats between the US and China, equity markets still kept climbing higher and higher, right? So it seems that they were able to ignore a lot of that noise, all right, and still focus on the fundamentals. And I mean, granted, the global economy was slowing even last year before the coronavirus hit, but there was still growth. And of course, the U.S. was a shining star, right, in an otherwise pretty gloomy, relatively gloomy, not as gloomy as now, definitely, but relatively gloomy outlook for the other G10 currencies last year. So I'm also, again, I was rattling actually translates into actual policies, right? Like what we saw with, well, what we could see with Hong Kong's special trading status being evoked, revoked, or more tariffs, or if tariff man comes back, I think that those kind of policy actions will carry more weight as opposed to just these displays of or the ruffling of feathers, so to speak. Okay. I think there was one more that I'm trying to get to. Um, yeah. Okay. Oh no, that's another technical comment there. Okay. Well, I'll tell you what. We are about 4 or 5 minutes over now. So look, if you still have some questions, you can send them in. But in the meantime, I believe Lukman will kind of take us home and talk to us about the how you can reach us here at FXTM. In the meantime, let me
Perfect.
just show my screen here, and then he'll take the social media channels. I guess in the meantime, Lukman, you can do a self plug there. Talk about your Twitter handle.
Yep, so I was actually going to share my. Okay, so just before we go, I just want to just share the disclaimer once more, just once more. Just to let you all know that the content that we spoke about today, you know, it's our personal opinion. From me and Han, it's not trading or investment advice. And we just want to let you all know again that trading forex and leveraged financial instruments involves significant risks and can result in a loss of your investment capital. You should not invest in more than you could afford to lose, and you should ensure that you fully understand the risks involved. Trading is risky at all times. It's been absolutely fun, guys, and if me and had it our way, we'll be here answering your questions all the way to, I think it's 10 p.m., 7 p.m. in Malaysia, and it's only 9:30 a.m. UK time. But you can reach. Let me see. You can reach me at. Let me just share my screen quickly, just so they can see where they can reach us via the Twitter handle. So you can reach us, you can reach the FXTM, my screen right here. You can reach us on Twitter. The Twitter handle for FXTM is at It's Forex Time, if everybody can see my screen right here. At the same time, you can reach me at Lukman underscore FXTM. So be free to ask away. Also, you can reach Han on his Twitter handle is at Han underscore FXTM. Han is quite active at Twitter, so don't be shy to ask him any questions. Also on Facebook, our Facebook is facebook.com /Forex Time. This is a great platform to ask any questions in regards to markets. We also share the stock of the week via the Facebook page, so please be free to tune in. For those who enjoy videos, media interviews, things more audio and visual, check out our YouTube channel, right here. So literally just type FXTM on YouTube. So these are the social media handles you can reach us with. As I said, guys, please don't be shy. Anything and everything that has to do with the markets, just ask along. We're more than happy to share our knowledge. I'll share the screen back to you, Han.
Yeah, well, actually, if the best way to kind of check us out or get in touch with us through our social media channels would be to go to the website. That's www.fxtm.com. And if you scroll all the way to the bottom, you essentially see all these icons there. And when to click on them, whatever your platform of choice is, your social media, whichever one is your favorite, be it Facebook, Twitter, LinkedIn, Instagram, YouTube, or Telegram, we are there. So you can just click on those links. If you forget all the handles and how to search for us, that's probably the easiest way to get a hold of us. Now, of course, a shameless plug here. If you go to the website, I think the first tab you should check out is the daily market analysis. I'm biased because Lukman and I, we do spend plenty of time looking at the markets and then penning our thoughts and posting them and sharing them with you on our website as well. Don't forget, we have a lot of educational resources there as well, and as well as other webinars by our colleagues. So long story short, we are here to help you, and build up and at least share what we know and what we are observing in the markets. Okay. So with that said, ladies and gentlemen, thank you all so much for being here. yeah, I saw a couple of questions come in, but I know we are 10 minutes over already, so we apologize for that. And just yeah, feel free to reach out to us on social media and we can interact there. All right. And so we'll leave it at that. Thank you so much. Please stay safe amid these uncertain and volatile times. And we hope to see you again for our webinar a month from now at the start of August.
Yeah, happy trading, guys. See you all soon.